Associates. David, thanks as always for being with us. We knew things were not looking pretty here in this country. What was your reaction to those headline numbers this morning?
Well, the market was already looking at employment to collapse 500,000. So, you know, when you start talking about numbers of that size, which would have been unprecedented in its own right, you know, you get to 1 million, you're almost, in some sense, numb. But at the same time, we know what the backlog of unemployment insurance claims look like already. And you're talking about probably another 3 or 4 million that are going to be coming into this data in the next little while. So this is probably just a thin edge of the wedge. But it's not much different than it is in the States when you're getting numbers, you know, well over 6 million on jobless claims. It's really global, but the employment numbers surely are going to get even worse before they get better. The market reaction is telling you that investors are already braced for it. So I guess if there's a silver lining is that a lot of this negative hit is being viewed as temporary and already has been priced in.
So let's dig a little deeper into that because, I mean, we've seen the unemployment rate, at least as of March, spike to 7.8%. So we had this stretch, basically a year and a half while it was holding below 6%. That is done. And the Bloomberg economics team this morning was, just based on the data we got today, calculating our Canadian unemployment rate possibly moving towards something as dramatic as 15 or 20%, which really sounds shocking for me to say, David, but what's your own forecasting?
Well, you know, I think that number is probably accurate, and I can tell you why, just based on the internals from today's jobs data, because it wasn't just the million headline employment decline. It was the fact that even when you count in people that were still working, hours worked in the overall economy collapsed 15% in 1 month. So when you're taking a look at hours worked and translate that into bodies, it's as if the economy had lost 3 million jobs last month. As bad as 1 million is, when you look at the labor market in a holistic way, it's as if we lost 3 million jobs, not 1 million. And if that would have happened, if we just, say, strapped on the hours worked effect onto the headline, the unemployment rate today would have been reported at 17%. So I think that as these hours worked number morph into more job loss, that's the sort of headline unemployment rate we're probably going to see in the next couple of months in the data.
All right. So you look at the outlook for economies like Canada. You also look at the outlook for the stock market. You know, you mentioned that we were already anticipating a decline of 500,000 jobs, so that would have already been a record number in this country. Maybe you could put today's data and the idea of how quickly the economy can recover into context, because I would have to think that some of the stock market rally off the lows right now is people saying, well, we are pricing some of this in, and we do feel eventually we'll get back to business. You know, when you field investor questions right now, how do you respond to that view?
Well, let me attack the second part of the question. I think that look, we've got this economic detonation going on because of the coronavirus. At the same time, we've got the reaction function of the government, both the Treasury and the Fed, and we saw what the Fed did today. The Fed's basically come in and said, we're going to pretty buy everything in sight. I mean, they're not buying gold yet, and they're not buying equities, but equities may well be next. They're basically, the cavalry is riding in to ensure that we're not going to get a second-round pernicious impact on the economy, you know, through debt defaults and insolvencies and downgrades. So the Fed here, especially today, has put a real floor under how bad this is going to get beyond, say, the second quarter. That's what the markets are basically pricing in to a large extent, is that this is going to be temporary. I don't think anybody is really talking about a V-shaped recovery anymore. I think even the bulls have basically given up on that thought process. I think right now we're just pricing out what could have been and what the Fed responded to today, and they must have known that we were going to be hit with a tsunami of debt downgrades from investment grade to junk, and that would have caused a major seizure in the corporate credit market. That's what they moved ahead of. So right now it's all about, for the Fed, removing as many negatives as possible. But I don't think there's a snowball's chance in hell that we're going to be going back to anything remotely looking like a normal economy until we get a vaccine. We get a vaccine, you'll get the V-shaped recovery. Unfortunately, that's probably not for another year. We start getting some treatment, well, that's something different altogether. And then we can talk about how, on a secular basis, attitudes are going to be changing in terms of how we travel, in terms of how we work. There's going to be a lot of fundamental secular changes taking place. But if you're talking about a real vigorous recovery, consumers are going to have to feel confident about going back to their old ways of spending. And that's going to hinge on what happens on the medical front. So my sense is that things are going to bottom out in the second quarter. A lot of this, what I call economic detonation, is not permanent. I think we bottom in the second quarter. I think the Fed, I would even say the Bank of Canada, has put a floor under how bad this gets beyond the second quarter. But I think that the recovery is going to be very slow, and things will not generate significant sustained momentum until we put this pandemic behind us and people's fears about going out and engaging with each other again, resorts back to what it might have looked like previous to the mid part of February.
And I guess what's been so unbelievable to watch unfold, at least in this country, is the 1-2 punch. The fact that as we were first starting to deal with the fallout from COVID-19, you saw Saudi Arabia and Russia with oil prices start pumping away, and we saw that deterioration in the price of oil. And we've talked so much about what's happened to oil prices in this country. Now, David, obviously one of the big themes this morning has already been this virtual OPEC Plus meeting where everybody's waiting to see what kind of cuts can be announced. They've now officially gotten underway, still waiting for more official word, but there's already some reporting out there that at least Saudi Arabia and Russia may have a deal on some deep oil output cuts. I don't know how you quantify deep, but we're looking at an intraday chart of oil, which initially spiked on that news. You talked about people feeling safe again, finding vaccines as storylines tied to the economic recovery. How much of this narrative we keep talking about coordinated production cuts, how does that play a role in how things play out for Canada's economy?
Well, Canada ultimately is part of the answer towards, from a production standpoint, which means, of course, if you've got to cut production, that ultimately helps reinforce a better tone to the pricing mechanism, so long as it's done globally. But production cuts end up meaning more job losses in that particular sector. So it's almost like you got to commit hara-kiri to actually get the price back to some sort of sustainable level, and then we have to discuss what the important price is for the Canadian producers against what they are for the global producers, and the homegrown supply problems that we built up politically in this country in that respect. So. I think that the attempt to cut production is going to provide a brief lift. The hole that has been created in terms of global demand for energy is just massive. I mean, you're talking about 20 million barrels a day, and maybe we'll see these production cuts globally offset half of that. That's already starting to get priced in. The way these markets move today, they just price in a full year in a matter of a couple of days. So we're not going back to $50 oil, or we're not going back to $40 in WTI just because of this. We would have to see demand start to revive, and that's going to only happen once this deep recession plays its course. And then you've got to take into account as well in the future how many people are going to be driving to work anymore, because I think that this work from home wave that we've seen is going to catch on for a lot of people. Well, fewer cars on the road means less demand for fuel. So to be bullish on, there's already reasons not to be bullish on oil because of the ESG wave, but I think that actually everything that's happened since, notwithstanding the production cuts we're going to see, is that oil is going to be in rough shape for an extended period of time.